It's already a massive week for markets with significant downside kicking in on Monday off the back of the tariff talk from Donald Trump. But we've started to see that recover somewhat with the Mexico tariffs being kicked back for a month after negotiations between the two sides. While Thursday brings the UK Bank of England interest rate decision, there's question marks about what the outlook's going to be for all of these different countries involved, given the uncertainty that we're faced with at the moment. But markets are expecting a 25 basis point cut. So let's get into the nitty gritty and try to look at exactly what the outlook is for this meeting and how we could see those expectations shift over time around what the Bank of England's going to be doing. So here is the market expectations according to Refinitiv. And essentially, like I've said, there's an expectation we see 25 basis point cut this time around. That's 94% chance attributed to that. Beyond that, you're looking at the second rate cut of the year taking shape in May, with 54% chance for a move to 425, 17.6% chance down to 4%. But ultimately, you're looking at roughly 3 rate cuts over the course of the year. Now, interestingly enough, this is seemingly front-loaded. We haven't got the back end of the year on this, but there is an expectation that it sort of slows down in terms of the view of the market going further out because there's greater uncertainty, and that's to be justified. But bear in mind, when it comes to inflation, things should hopefully calm down a little bit at the back end of the year. This is the inflation annualized for headline inflation for the last 6 months. What's the trajectory of inflation consistent with? When the UK is consistent with a move down to 2.2, but the last 3 months have seen inflation pressures pick up. 4% is the current pace that we're tracking at when it comes to the last 3 months. Notably, the one line that's been updated more recently is the Eurozone figure, and that came in very low in terms of both core and headline. So the Eurozone certainly destined for well below 1% in the near future, in my reckoning. But if you look at the core figures, things look even better for the UK because we've got 2.5 on the 6 month, 2.7 on the 3 month. That means that, you know, in 6 months' time, we should be in the mid twos. Notably, that isn't necessarily at target, right? So it really depends on the how comfortable the Bank of England are with cutting rates, despite the fact that they're not at that 2% target quite yet. But certainly, we're not necessarily seeing that major surge coming into play as we saw on the 3 month annualized for the headline inflation. That highlights the fact that energy prices have been a problem. We've seen it for the latest Eurozone data as well. And this really shows what a key role energy is going to be playing going forward. Notably, Donald Trump has done one thing since he's come into power that's good for markets, and that is drive down energy prices so far, with oil essentially heading lower ever since he's stepped back into the White House. But certainly energy is going to be a key component going forward. But so there are question marks, right? There is an ability to cut rates with inflation around your mid twos. And, you know, that's what we're tracking at now over the past 6 months. But there's question marks. And that's because, okay, Donald Trump's come out and said he thinks that the UK is largely in line. It doesn't have to do too much, but might have to do a little bit. The UK is in a decent position when it comes to negotiations with the US, but what we've seen in terms of selling pressure for the FTSE 100 to FTSE 250 at the beginning of the week highlights the fact that ultimately tariffs and the tit-for-tat trade war between the US and Mexico, US and Canada, US and China is not good for global growth as a whole. Global economic activity suffers, and that's bad for companies, even if they are in a jurisdiction that doesn't necessarily have those tariffs. We can see here in terms of the breakdown, in terms of the goods trade balance between the US and some of these other major nations. You can see why, in particular, it's the likes of China, it's the likes of Mexico. And on this one, you can see the Euro area as well, a major issue. But notably, he's really taken aim at Canada. You can see Canada, for one thing, has been largely flatlining over recent years in terms of that deficit. But also, if you take away energy, then there wouldn't be a deficit, and it really depends on whether you want the energy or not. If you don't want to import it, then fair enough. But you know, that's a good thing. That's bringing down the cost of energy in the region. But Trump seemingly doesn't see it that way. Crucially, you know, we've got to keep an eye out for these negotiations, because when we're looking particularly in the FX markets, but across the indices space as well, these breakthroughs and will really do well to sort of dispel the downside for equities, but the strength of the US dollar, things like that. What we've got to grow accustomed to is the idea of, just like they've kicked the can for a month with the Mexico discussions, the idea that on one day you're going to be talking about huge tariffs and a breakdown in terms of economic growth. The next day it's been allayed by a month, or you've found a resolution, and for the time being. And so there's going to be a lot of volatility over the coming years. And certainly anyone that traded over the period of Donald Trump's previous presidency will know that what you get in terms of market conditions from one day can change to the next under Donald Trump, because you put a mic in front of him and he's liable to say anything, quite frankly. In terms of the sort of FX space, what we've seen here is the likes of cable is largely sort of moving in line with the services PMI. Of course, the services PMI is heavily lined up with the UK economy as a whole, heavily reliant on the services sector in particular. And certainly if we see weakness in terms of the services sector, that denotes sort of weakness in terms of global growth, US growth as well. Certainly if you're seeing weak services sector, that generally is something you see across many different countries, and therefore that benefits the US dollar. Now, of course, at the moment we're talking about the fear within markets, and that is being reflected by initially significant downside. You can see that gap lower in terms of the price for cable at the beginning of the week. Let's just put this into full screen. So you can see here we gap lower. Now we've rebounded, and certainly that news coming out of Mexico is one thing that's driving this. But certainly markets are becoming a little bit less fearful. But if you look from the sort of daily perspective, the downtrend playing out since those peaks in September still does remain in play. If we look on, say, the weekly time frame, you can see that we've come back into an interesting area of support here, where you've got this low here at 12037. But certainly, if you're looking at this sort of stepped move higher, that appears to be over now with the fact that we've broken through the 1229 essentially. And so that points towards a possibility that the bears are going to be back into play soon enough. There's going to be a lot of chop, I would say, but if you look at this move, that is a sort of straight line move. We didn't really get much of a pause on this 4-hour time frame. Now we've rallied and now started to roll over, crucially breaking below this swing low, which also is at 122.99. And now we're regaining ground. So there is a good possibility that this is a retracement, not necessarily respecting it too well on the way up, but now we're sort of ranging between the 76.4 and the 61.8. We break back down, but now we're looking, are we going to respect the new area in terms of viewing this as a retracement? So we've come into a sort of deep zone here. Let's see if it was sort of seen from a wider perspective. Not particularly. So anyway, we're coming into what looks like a potential retracement here at the moment. Certainly if we were to break up through your near-term resistance 125s, 125.2, then that sort of builds a narrative where we could start to base out for this. But certainly the trend is bearish. Yes, you might see a little bit of good news coming out of Mexico, but there's still some really significant potential back and forth between Canada, in particular, likes of China, the likes of the Eurozone. And so if they've managed to one by one knock these out, then all of a sudden you start saying, well, we're actually in a much better position than we thought we were, because you're essentially coming into this thinking we could have tariffs. And if they manage to get those out of the way, and, Mexico's only a 1 month delay, but if they start to show that essentially this is just a negotiations tactic, they don't actually want to implement it, then, that could drive US dollar weakness. But we need to see that. And so for the time being, we're seeing some respite from it, but the downtrend does still remain intact at the moment. But if we break up through your near-term resistance level, your sort of 125.2, then that does start to build on the narrative that actually that initial sort of flash sell-off that we saw at the beginning of this week is a short-term fleeting move. But really, a lot of this is going to come down to what's happening in terms of US relations with these other countries. Now, when you're talking, of course, we're talking about this BoE interest rate decision. Well, by and large, markets are pricing in a rate cut anyway, right? So that is that. So markets have got to look beyond that. What else are we going to get from this meeting? Now, when it comes to this idea that we're going to see the Bank of England laying out plans to cut rates by a significant amount, more so than markets are pricing. Well, the Bank of England is also going to be wary of the idea that they might be hit by some sort of left field economic shock through tariffs and a breakdown in terms of global activity. So they might need to move. And so you should look out for commentary around that. Are they saying that they stand ready to act to a greater degree if necessary, and things like that? Those are the kind of things that could point in the direction of them cutting rates to a greater extent. Now, of course, the UK economy isn't necessarily targeted to the same degree as some of these other economies, it appears, but nonetheless, there is a possibility we could take a hit. And so look out for the commentary that comes alongside it as people are trying to judge market perceptions around how much we're going to see in terms of easing going forward. In terms of the FTSE 100, you can see we have broken into record highs of late. This is a kind of index that spends a long time going sideways and then breaks higher, and then you're just back in another sideways phase for the best part of a year. Well, what have we seen? Well, we've seen best part of 9 months or something of consolidation. Now we've broken higher, so we're in that sort of exploration phase. How long does that last? You don't know necessarily. We're seeing a bit of pullback at the moment, but let's hope that that phase isn't over already. It feels like it's only just begun, really, and we've pulled back into this sort of deep retracement zone at the moment. So as long as we don't break through this, let me just get this into a regular scale there, through this 84.37 low, then this pullback at the moment to me looks like a retracement before the bulls come back into play. Of course, as you can see here, we're starting to roll over once again, but this zone is going to be really key for the time being. 8,500 up to 85.37, sorry. That zone's really key. It needs to hold for the bulls to sort of come back into play once again. Certainly, if we break that 84.37, then it starts to look like things could start to get ugly and we unwind some of the big gains that we have seen at the beginning of this year. But certainly, there's a lot of question marks at the moment. Quite honestly, a lot of these economic announcements, people are going to just look at it through the prism of what's happening in terms of tariffs and what will the Bank of England do in certain circumstances. That's going to be key as we go forward. There's a good chance that if we do see inflationary effects coming into play, it means the Bank of England does less. If we see weak growth coming into play, it means that Bank of England could do more. And so the data dependency rule is probably likely to reign supreme. But this time around, markets are expecting a rate cut. And hopefully that should provide a boost for the FTSE 100 coming at a time in particular where you see more of a focus on potential downside for companies in mainland Europe and alike. I hope that's useful. We'll be providing plenty of updates along the way in terms of the trade war and in terms of some of the different economic announcements that will be coming out. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.